Well, hedge fund manager John Paulson, who made a fortune betting against U.S. mortgages, listens to our next guest, so you should listen to him as well. Chris Thornberg is the co-founding principal of Beacon Economics, the research firm that focuses on real estate and local economic and policy issues. He's coming to us from California. So, Chris, thank you for getting up so early for us here, East Coasters. Okay. First off, QE2, what kind of impact is that going to have, if any, on the housing market?
Well, on the housing market, it really depends. A lot of it's going to depend on whether or not the bond market sees this as potentially inflationary, which will drive mortgage rates up, and of course that'll hurt the market.
Right.
Or equivalently, if they think see this as stimulative, you could actually just see the bond market stay where it is, keep interest rates low, and obviously that's a big help for the housing market.
Right, and right now I'm looking at the yields, and it's not so good on the 30-year. They're going down, the yields are going up, but so far so good on the intermediate area of the bond market. So looks positive so far?
Well, I'd have to say that so far, yes, absolutely a positive effect. Of course, we know the positive effect it had on the equity markets yesterday, and that's also good for the housing market. As people feel wealthier, they want to go out and start buying more of those hard assets.
Right. Okay. And Chris, you say that it's caca that jobs depends on a housing recovery, but surely the other way works, right? Or the other way is true, that basically you can't get a housing recovery without jobs, right?
Well, no, not necessarily.
Okay.
Realistically, when a housing bubble breaks, the market tends to sit on the bottom for 3, sometimes 4 years, realistically long after the labor markets recover. During that point in time, you're sort of reforming organic demand within the market. People are building up equity. They're having kids. They're finding new jobs or new careers in other parts of the United States. All these things have to start occurring. Frankly, whether or not the labor market returns, it's pretty unclear to me that the housing market is going to come shooting back anytime in the near future.
Okay, so what's your forecast then for housing?
I really honestly think that the market's going to basically kind of sit in this neutral mode for the next couple years. On the construction side, we have 2 million, 2.5 million excess units across the country that need to be absorbed before that market can really get up and running again. On the sales side, right now, Americans have record low equity in their current homes. That's going to have to go up to get that resale market going. So all in all, I continue to say that this market's going to sit on the bottom for a couple of years at least. And I think we all just have to accept that fact.
But does that make it a good time to buy, like what John Paulson says?
Well, if you look at affordability, and by affordability, we're looking at the cost of a home relative to people's incomes, it really is at an all-time low level, in part driven by the steep decline in prices that's occurred since the housing market broke, but also because of this big decline in mortgage rates. So right now, affordability at that low level, if you are thinking about buying and you're in the financial position to be buying, absolutely this is a good time to buy.
Right, this must be actually kind of like an opportunity in a lifetime, right, for those who want to buy.
Absolutely, but again, opportunities of a lifetime really depend on you being in the right financial place. As already noted, a lot of Americans simply aren't in that place. Their savings have been hit very hard by the downturn in the markets. A lot of folks just don't have the equity in their current structure that they had a couple of years ago because of the decline in home prices.
Okay.
And so if you're in that position, it's fantastic, but otherwise,
not so, right. Okay.
Not so, yeah.
Chris, I want to ask you about this foreclosure issue, which we've talked about. How big of a deterrent is that going to be in the housing market?
Well, you know, the moratorium that's going on right now, or I guess the partially enacted moratorium, since some banks are already reversing course, is really wrapped around sort of technicalities in the foreclosure process, crossing T's, dotting I's, that sort of thing. While there's a lot of attorneys general out there who are making a lot of populist hay out of this particular circumstance, the reality is this. People get foreclosed on because they stop paying their mortgage. J.P. Morgan, for example, a couple weeks ago had announced that the average home they put into foreclosure is 12 months delinquent on their payments. That's a year behind on making payments on that mortgage. When you get right down to it, because of this, it seems highly unlikely that really anything's going to come of this entire moratorium beyond slowing things down for 4 to 6 weeks.
Only 4 to 6 weeks.
Well, you can already see, again, some of these banks turning on a dime. and starting to move up into the foreclosure process again. They've realized that really these are just technicalities. What they have to do is they have to be a little more careful, a little more diligent about the paperwork, refile some of those papers, pay the fines that they might have to pay. But realistically, this really isn't going to change anything.
Okay, so it sounds as if from your view it might be over pretty quickly. Chris, before I leave you then, price increases, what do homeowners have to contend with for the next 2 to 3 years?
Well, if you think about again, the underlying drivers of price increases, mainly demand versus supply, there really shouldn't be much in the way of price increases over the next couple of years. Now, we have seen prices slowly drift up. Both the Case-Shiller Index, the median price numbers coming out of the National Association of Realtors all point to a slowly increasing price base. But most of that has to do with the shifting share of foreclosures versus non-foreclosure units in the overall marketplace.
Okay.
As that continues to shift towards more normal sales, prices will seem to drift up, but realistically, that's just a change in the mix. Prices are more or less staying flat.
Okay, but when we're talking small, like 2 to 3%, right? Something like that?
Yeah, exactly,
okay.
If even.
Okay, all right. Chris, thank you so much. Really appreciate it. Chris Thornberg of Beacon Economics on the housing market.